The emerging companies part of the Australian market is definitely where the excitement is right now. Although you're going to need a bit of nous to navigate through there, along with the success stories, there's plenty of landmines in this part of the market. Today I'm joined by Julian Babarczy, who is one of the portfolio managers at Regal Funds Management, one of Australia's most enduring and long-term hedge funds. We're going to talk to him a bit about his investment style and some of the opportunities he's finding at the emerging companies end of the market. Julian, thanks very much for coming in, and great to have you in at Livewire.
Well, thanks for having me, James. It's a privilege to be here.
Great. Well, listen, why don't we start with just a little bit of background around investing and what was it that got you to investing personally? Like, why are you passionate and why are you here doing it today?
Yeah, sure. I think my background investing dates back to my teenage years. So I wasn't as early an investor as some others in the firm. I think Phil King, who launched the firm, has a story of him buying his first stock at age 14 or 15. So I was a relatively late comer. I think I bought my first stock at age 19. Yeah. But I didn't come from a financial family. My parents are in the medical industry, so I sort of found my way in the industry just through I guess working out where my passions lie. So went through university, started with a marketing degree, and very quickly realised that there was a big thing called the stock market out there that was much more exciting than the marketing industry. And so started reading the paper a lot, and then taking an interest in buying shares, and then sort of diverted my career down the more financial path by doing some extra study on top of my marketing degree, and then managed to land a job quite early at a very entrepreneurial merchant bank in Melbourne, which I got exposed to a lot of very early stage and conceptual style companies, but a really exciting environment where I got quite hands-on with some of the companies and really just loved it from early days. And then the rest is history a bit, and I've sort of navigated my way through to my recent position at Regal, which I guess I didn't join so recently ago. I've been there for 13 years, and it was my move from what was prior to that investment banking, where we're working 100-hour weeks and really a lot of wheel spinning, where you'd be working long hours on transactions that wouldn't go ahead. And I wanted to get across onto the buy side and met the guys at Regal, and have just been really enthralled by the opportunity to actually get hands-on investing money. All the positives and negatives that go with that, but it's been a really successful story. So I joined Regal in 2006 when we had about $20 million under management. We now manage about $1.7 billion, and that hasn't been a straight line, of course. There's ebbs and flows in everything, but yeah, it's really just it's been a great environment to work, and has just taught me that I love looking for the next great company and investing, and it's what gets me up in the morning. So it's a great environment to work in.
You've used the word entrepreneurial, and we're talking about emerging companies, and Regal's obviously in a boutique space. Is that the edginess or the excitement of that smaller part of the market? Is that what you've got a real passion for? Yeah,
look, without a doubt. I've spent stages in my career looking at larger companies, and while you can run much larger amounts of capital at that end of the market, for me, there's nothing like the thrill of finding a company that can go up many-fold on you, and that's really part of what the Emerging Companies Fund is about, allowing us to express that view. Much higher risk opportunities, but ones that you get really passionate and excited about, and that you can find something before the rest of the market has, rather than, I guess, pick over the scraps of what the market already knows about. And so the whole ethos is trying to find parts of the market where we're some of the first investors to take an investment view. Some retail people are early to markets. I think we pride ourselves on being one of the earlier institutions to many situations, and that's really what floats our boat a lot of the time, is being early and getting excited by a new opportunity that we think the market will gravitate to and grasp after hopefully we've got ourselves set.
Well, let's go into that, because if you're going to be first and you're going to be early, you obviously have to have a lot of conviction and self-assurance. Yeah. About the ideas that you're putting in there. So what are the key ingredients that you're looking for? Like, how do you start to build an idea?
Yeah, well, I guess we build our ideas a bit organically. There's no one way of doing it. So it depends on the type of investment as well. We invest in established businesses where we're getting broad investment opportunities that might be packaged up for us, and in that regard, we're just responding to situations. But the thing that we find most exciting, I think, is uncovering new companies. And so that's where we're looking at various industries, and sentiment changes, maybe some more thematic style investing, working out what themes investors might be gravitating towards. And they're not just themes for the sake of it, they're ones which we think have really good economic fundamentals underpinning them. And then it's spending your time going out and finding early stage companies who might need some money, because the precursor is they need to want to have Regal on the register for some reason. And so we've got to find companies that may need capital in the short or medium term, and then trying to build relationships with them, work out whether they're the companies that we want to also get behind. And so we start by looking really at the business model and the opportunity. Ideally, we want an opportunity that can scale quite a lot and has, in many respects, potential global applications where the upside is somewhat unlimited, although nothing's unlimited, but has enormous upside. And then we're looking for business models that really make sense as well. So typically we're investing in Australian companies, so we have to ask ourselves how and why an Australian company can execute in what is often a global marketplace. And so it's got to make sense to us that they can do that. I think that starts and ends often with management. So we spend a lot of time analysing and interacting with management teams to work out whether they've got, I guess, both the prerequisite experience. So is there analogues of what they've done in the past that suggest they can do what they want to do in the future? And also just whether they're of the temperament that can handle often hyper-growth environments, because you're going from companies which have often zero or very modest revenue and going through phases of very high revenue growth. And that brings a whole lot of challenges. Human resources challenges being one. You've got to scale up your business while you're going through that. You need funding challenges, or you face funding challenges, and how you make sure you don't impair the business, because you need a lot of capital and working capital to fund a lot of these high growth environments. So it's a certain sort of entrepreneur or leader that we need to get comfortable with, has both the operational expertise and also I think the leadership skills to take some of these companies from very modest and humble beginnings to something much more special. And then I guess there's external factors as well. Is the valuation right for us? Can Regal get in at a valuation which gives us the right risk-reward payoff? Ideally, we're looking for very large potential upside in some of these more conceptual situations where we can get set in situations that have modest downside. So the valuation is that compelling that even if we get it wrong or don't get it entirely right, we'll still probably make money. Yep. And so it's making sure we got that valuation point correct as well. And then I think, sort of dovetailing back to where we started, it's working out areas where we can perhaps get a research or an informational edge over the market by being there quicker and identifying themes and companies which we think will resonate really well once X, Y and Z is delivered within the company, and then taking our position there with the hope and belief that our process has led us to a company that can deliver. And then as it does and the broader market accepts that, you often see a huge re-rating. So we call that a bit of a research or an informational arbitrage, which is us just doing our jobs as analysts and portfolio managers.
Well, can we take a step from the theory and apply it and talk us through how this process looks in life? Is there an early stage Australian company right now that has some of these attributes that you can share a bit of your thesis with us on? Yeah, sure.
There's a really exciting IT company at the moment called IZUP. It's got the ticker IXU listed on the stock exchange here in Australia. So they're a very early stage technology company. They've got some IP that helps with database collaboration in a really secure environment. So what that means in practice is that their IP allows disparate organisations to share data without the risk that data can be hacked. And we're all obviously aware of the hacking issues that are going around quite regularly globally, whether it be credit card details or private information that gets hacked from very large organisations. So IZUP have a solution that has the potential to ensure that those hacks can't occur. So hacks obviously cost companies on many levels. One is financially, when they've got to reimburse people, and also reputationally. So it's becoming a big and increasing issue. And as everything moves online, we expect databases to be shared increasingly online for good reason, like marketing reasons and other sorts of reasons. And we think the world is screaming out for a solution that can help limit some of that risk that corporations face. So IZUP have developed a bunch of intellectual property around that, and they're in the process of rolling that out now to a bunch of different verticals and a bunch of different customers, both domestically and hopefully overseas. So it's got a 50 million market cap at the moment. It's operating in a truly global playing field where if its IP does work, and we think it will over time, that it can sell its product anywhere around the world. So it's one of those situations with really, really big upside and quite a modest market cap now given the opportunity set it could hit. And so we think as 2018 progresses, we've got very strong hopes that the management team can deliver and show that the commercialisation paths are actually valid. And they've got a number of different pathways they're chasing down. We obviously don't know whether they're going to be successful, but we think the risk reward is skewed towards them being successful, at least initially. And it's a very high risk situation though, to be fair. It's not a blue chip by any stretch, and it's very much up to the company to deliver. But that's a company which is, as we talked about, a great idea, a great business plan, one which is very logical, and they've got a team of initially entrepreneurs who got it to a point, and then they've brought in much more senior management from more established IT companies who we think have got the wherewithal and the networks to really execute on this business plan.
So as you follow the progress of Eyes Up, what will be the milestones that matter most to you? Will it be to see adoption from the market? Will it be revenue generation? Will it be validation around a particular market avenue they go to? What will matter most to you?
Yeah, we'll be looking very closely for whether they can sign up and demonstrate that there's a lot of customers out there. So I think initially we'd look to see
market size.
Yeah, market size, and also just some indication that large players in the market are engaging with their product, because that's when this is a relatively conceptual business model. The IT is solid and works, but they've got to prove they can apply it to real life applications. And so we're looking to see them sign up customers that we recognise, who are happy to pay money and actually bring their IT solution on board. And for us, not being experts in every bit of the IT world, that for us is validation that the market exists. And then we'll be hoping to see numerous either MOUs or firm revenue generating contracts that are leading towards revenue, because ultimately it's one thing to have MOUs and one thing to sign customers, but you've got to generate the revenue, which will lead ultimately to the profit, which at the end of the day is how all these companies will get valued. So we're happy to take a bit of a view that a company can achieve revenues, but clearly we need to be in situations that can actually transition through to profitability. So ultimately it's demonstration that they can not only make money at the top line, but at the bottom line. But initially in this situation, it's customer validation, both domestically and offshore, that their IP is as good as we think it might be.
Julian, you're clearly passionate about this early part of the market. If we're to drill down to a particular thematic or a particular area of passion, like what's the one market-related topic that you could just sort of chew someone's ear off in a pub for a whole afternoon?
Yeah, well look, I've done a lot of investing in the mining space, so that's quite dear to my heart. I entered the industry many years ago, more of a financial guy, and then I've done some studies to try and skill myself up so I can understand a bit more around the geological aspects and the like. So, and the mining industry is very exciting. You meet very colourful characters, and there's obviously a lot of beta in the stocks as well, so they're quite volatile, and that can be as exciting as it is hard to deal with at times as well. But the mining sectors are very, very dear to my heart, and I think one area where I've got strong views is where are we in the cycle? Where are we in the mining cycle? And that I think is what investors are grappling with at the moment. I think there's conflicting views around where we are. Some people think we're late cycle because we've seen a raft of raisings in the last 9 or 12 months. We've seen share prices move for smaller companies many hundreds of percents, and that to some people is a view that we're getting a bit tired and a bit old, and that they've tapped the market and raised significant amounts of money. So my view on that is, though, that these companies were starved for capital for a number of years through the bear market, which was very severe and one of the biggest and longest bear markets we've had in mining for a long, long time. And so I think what we've seen with those capital raisings is just a catch-up on previously starved balance sheets. And I think the share price movements are really just a catch-up on what was probably overly depressed pricing around the view that the mining cycle may never return, which is clearly not something that always returns. So I think based on some of that, I don't think we're as late cycle. I think we're genuinely early to mid-cycle. There's a lot of macro discussion around inflation globally, which is a real concern for, I think, a lot of markets. But it tends to be very positive for mining companies, and that's because inflation tends to lead to higher commodity prices, which is obviously good for valuation support and just the general environment for mining. So I think inflation in a mining context is a positive. And so I think, again, that's just starting to bite globally, and I think that's an exciting thing for me. The other thing I think we've seen is a lot of capital discipline, particularly at the larger mining companies who are hoarding very large amounts of capital. They've been very much focused on shareholder returns, so capital returns, rather than growth, which has been a nasty word during the bear market. But I think what we will see over the next period of time is I think boards will become a little more emboldened and shareholders will become a bit more focused on growth. And I think the message will get back to boards that at some point you can't hoard cash forever. You've got to start putting it to work. So they'll start either investing in projects they've got in their own portfolio, or more likely they'll start doing M&A. So I'm quite excited about where we are in the M&A cycle now for the mining sector. Big cash piles. You've got the ability to buy companies very cheaply, often cheaper to buy than build. And I think you just need one or two brave CEOs to try the M&A tact and see their share prices re-rate, and then I think you'll get a subtle shift initially in sentiment, but then an increasing shift towards let's put some of this money to work. So I think we're probably in the early stages of a growth in M&A cycle in the mining cycle, which again is another very positive aspect for me. So that's one of the things dear to my heart and that I'm very passionate about.
Let's go one step deeper. Talk about the commodity spread. Is there a particular commodity right now that you think is in a real sweet spot or about to hit a sweet spot where you think there's great value about to emerge?
Yeah, well, look, there's a bunch of interesting commodities, to be honest. I think inflation tends to drive the base metals more so than some of these other ones. We've been heavy investors in the battery mineral space, as you know, so we've made good money being early there, and we think that thematic has a long way to run. And so there's a lot of exciting companies there, but I think around the inflation and the more traditional edges of the industry, there'll be a focus on base metals. So in that, I mean copper. Copper output looks to decline from about 2020 overall. Head grades are dropping because the easy stuff has been found essentially, and I think there'll be a requirement for some of these bigger companies to backfill their copper production portfolios, and so I think anything in the copper space is really interesting. Nickel's another one. It's quite a small market and tends to be much more volatile. We've seen large stockpiles that are marginally starting to draw, which is a very good sign. But then you've got a real groundswell of demand, which I think is growing through their application of nickel to electric vehicles. So a lot of the lithium-ion batteries have nickel in them, and we think that's a bit of a sleeper and is something that's going to drive nickel demand and likely nickel prices and obviously then nickel equities over the next 5 years. And so there's some of the more traditional ones. Obviously, we spoke about battery metals. You've got things like lithium, which we're very positive on the medium term. There's a lot of broker discussion at the moment as to when the oversupply is going to hit. We think the demand profile is much stronger than what people think, and there's much more longevity to that demand cycle than what most people think. So prices will, in our view, stay stronger for longer. Yep. You've got cobalt, which is a commodity that no one really knew about a couple of years ago, but it's a key ingredient in batteries. And that supply just can't turn on quick enough. And so we think that's structurally undersupplied for a decade and is a really exciting commodity to get involved in. And then you've got some much more niche commodities, and some of these would never have been heard of. So a new one we're looking at is high purity alumina. So that's a commodity which is used at the moment as the substrate for LED lighting. So it's had very strong growth around the LED lighting rollout that's going on globally. But they've recently found that it works very well in a battery separator as well. You need very high purity alumina, which is also known as HPA. Mm-hmm. You need very high purity HPA, and there's a couple of companies in Australia which are looking to develop HPA straight from kaolin deposits, which has never been done before, so they're high risk, but the upside for them is enormous based on them proving that they can develop these flow sheets. And we think a number of them have got really good opportunities to develop that, and these companies are trading at 10 to 20 million market caps, and if they work, the upside is 10 to 20 times over time. Okay,
and can you drill it down one more level? A resources company that at the moment that you're excited about, you think valuation's compelling and it's got that big long runway?
Yeah, well, one is in the high purity alumina space called FYR Resources. They're a WA-based company and they've got a very good quality kaolin deposit. It looks to be one of the most simple flow sheets for turning that kaolin into HPA. And they are in the early stages now of proving their metallurgical flow sheet, and that'll flow through to then PFS studies, which we think will demonstrate extremely robust economics and very large NPVs. Obviously, there's a lot of funding that goes on. There's also a lot of metallurgical risk, also execution risk, and the fact that HPA has never been created from kaolin before, that's a clear risk. But the pricing of these companies is so low, I think, relative to where they can trade over the next few years once they've proven they can do it, that you're sort of getting paid to take a lot of those risks. And the news flow over the next year or two at least should be relatively low risk, just de-risking milestones around studies that we think will be very positive and will lead to very big re-ratings that allow the companies to further fund the next leg of growth through subsequent capital raisings at higher prices based on de-risked share prices, we believe.
Yeah. I think one of the great things about sitting down with you is that you're clearly on the lookout for new ideas and looking for fresh opportunities. I'd be interested to hear about something that you've read recently that's really struck you and as an exciting opportunity or something that's really got you to sit up and go, wow, that's something new, that's a fresh opportunity.
Yeah, well, I mentioned earlier around the battery mineral space, and I think we're getting a lot of press out of that space at the moment, which to me is quite huge news, to be honest. It's quite rare to see end users look to secure supply, and A great example is an article only a week ago where Apple, which is obviously a technology company and really has no right sniffing around mines and trying to secure supply for raw materials that they don't use themselves, that their supply chains use, but they put out a press release the other day saying they're looking to secure cobalt supplies. And I think to me that is a great demonstration of how tight some of these battery minerals markets are. There's some in the market who think that the supply wave is about to hit in some of them, but I think what we're seeing from the end users, which are the true determinants, I think, of whether the supply and demand is matched, is that you've got some of the end users who are very happy to be in parts of the supply chain which they've never been before, and they're only doing that because they have real concern over whether they can access the raw materials that they need to build the products that they sell to their end user customers. And so that's a hugely exciting time, I think, for the whole battery mineral space. And we're seeing it time and time again. We saw an example today of a company we are invested in called Pilbara Minerals. They're a lithium producer, and we saw one of the large, POSCO, a large Korean company, who just bought a stake in the company and secured offtake, and also partnered with Pilbara for some downstream processing. And again, it's a great example of the end users who are leading by example and showing just how tight this is by spending their money to buy stakes in companies to secure supply. And that, for me, is a far stronger signal than, I guess, listening to market commentators who tend to focus on very high-level data rather than really the end users who dictate what happens in the market.
Yeah, great. If I could finish up with something or a lesson for our listeners or viewers to tune into. If you were to be really frank with yourself about some of the best lessons that you've learnt about investing in this part of the market and rules that you would take along with you, what would be some of the things that you would share about investing in emerging companies?
I think one of the most important things is doing your work on the way in. So because of the illiquid nature of some of these parts of the market, you've really got to make sure you're making the right decisions, because you don't have the luxury often of changing your mind or listening to new data points when they come out and exiting the position. So you've got to do a lot of work on the way in. I think you make the best returns finding situations which aren't well understood by the market. So you've got to be early and be, I think, embracing of new ideas and sometimes new technologies, and having the fortitude, I think, to invest in situations when you don't have full information. And I think having not full information means that you must get an evaluation that protects you against the risk that the full information leads to a negative outcome. But I think you've got to be understanding that you're not going to have every bit of risk accounted for in your business model, in your process. So another important area, I think, is again, having the fortitude to admit you're wrong at times and not be too wedded to situations just because you're already invested. So sometimes cutting your losers is a really important strategy to do. But then when you find something really good, often at the early stage, it's a temptation to sell it after it's had a good run just because you want to lock in some profits. And the best returning examples in my history have been where you've let your winners run. So if you're onto a good thing and the stock valuation still stacks up and you think there's a range of catalysts that continue to take it forward, then you've really got to maintain your conviction and stay with that story, because that's where you make the greatest returns, sometimes in not selling something, and make good returns in sometimes not doing something, which is selling after a big run and actually staying on for the next leg up.
Great. Well, Julian, thanks very much for sharing all those insights. Thanks for spending some time with us here today.
Pleasure, James. Thanks very much.